As people continue to join in, let me start today's webinar in the Future of Financial Information series. It's my great pleasure to welcome Stephan Hollander from Tilburg University. I have to say it's a great match between person and location. Guess you get that a lot, Stephan, but sorry, just couldn't help myself.
You're referring to my last name, I guess.
Indeed. Yep. So who will be the presenter today, and also Jordi Mondria from University of Toronto, who will be our discussant. So the timeline for today is Stephan will present for 30 minutes, followed by Jordi's discussion for 15 minutes, and then we will have another 15 minutes of Q&A with the audience. But you don't need to sit on your questions until the very end. Feel free to put them in the chat or just mention that you have a question. And so I will keep an eye on this and then moderate the Q&A once we get to that point. And so without further ado, Stephan, the screen is yours for 30 minutes.
Perfect. Let me start by saying that I really appreciate having this opportunity to present this paper. And first of all, Michael, I want to say thank you for your service to the academic community. I think running this series, this webinar series, is fabulous, and hope one day that COVID will be gone and we can go back to normal. But I really enjoy you running this webinar series, so it's a great pleasure. And thanks for putting me up, and with this great lineup of people who in the past have presented their work in this webinar series. So thanks a lot. Also to Jordi, thanks for your willingness to act as a discussant. Really looking forward to your feedback. This is fresh from the press. This is the first time that I present this paper in its current form, which is joint work with Robin Litjens. And as the title suggests, this is on localizing investors' information acquisition. All right, so with only 30 minutes, let me quickly give some highlights of the main findings of the paper. As I indicate here on the outline, kind of two main takeaways from the study. First of all, we document previously undocumented geography-related diversity and information acquisition by individual investors, and I'll explain in a second how we measure this more precisely in the paper. And secondly, we use this measure then in an application where we look at the one of the oldest anomalies study in the empirical literature in finance. And so we relate our measure to the stock price reaction on earnings announcement day. So more specifically on the earnings announcement day premium. And we find that this measure, pre-announcement information acquisition diversity, elicits stronger stock price reactions on earnings announcement dates. We've been working on the paper, so we sent a paper to Jordi and Michael some time ago, and we've been continuously working on it. One of the recent things that we added to the paper is we also looked into the effect of media coverage, because we think it might be an alternative explanation for some of our findings. So a quick recap of the findings here, in case I may not make it to the end, which is very likely, very probable. So we recently collected from the RavenPack database the earnings-related news articles covering firms. So for every firm during the -15 to -1 workday period, so that's in advance of the earnings announcement, but also on the day of the earnings announcement itself through 2 days after. And so this is corresponding to the way that we measure our dependent variable in the earnings announcement premium test. And so we include both variables, newly created variables, to our main specification. They both load in the way that you would expect them, and but our main variable of interest, which is this pre-announcement information acquisition diversity, continues to load and keeps its main sign, and also the magnitude doesn't vary much. So that's a great new addition to the paper. All right, so essentially, I mean, as the outline may suggest, the paper consists of 2 parts. In the first part, we look at, say, the asymmetry in information acquisition between local and non-local investors. And the motivation is in very short. If you look at the asset pricing literature, this literature traditionally assumes that first of all, there is symmetric knowledge, and secondly, all information, all historical information is symmetrically known. And this common knowledge assumption is behind like key papers in the theoretical papers in the field, like the no trade and no speculation results of Grossman and Stiglitz and Milgram and Stokey, for example. And so that's a really important assumption in this asset pricing literature. However, this characterization of symmetric knowledge and all information is at odds with the evidence that we provide in the paper that investors are, in fact, in the run-up to scheduled earnings announcements, pulling historical filings from EDGAR. And more importantly, perhaps, we document that this behavior is not symmetric. So what we do in the paper, very quickly, we look at the server log from EDGAR, which tracks the use of users who go to the website and download company filings. They're being tracked by their IP address, even though it's anonymized part of it of the IP address. We exploit this server log, and it allows us to classify users into local and non-local users. And we find that the users on these days, so that is on the earnings announcement days, in the run-up to the earnings announcement, these users of historical filings are mostly local, real geographically proximate investors. And interestingly, the non-local investors, they tend to display a tendency to wait until the earnings announcement date when new filings information becomes available. So we find this asymmetric behavior here, historical filings mostly being downloaded by the local investors who are geographically proximate to the firm, and non-local investors show a tendency to wait until new filings, new earnings-related information becomes available. A quick note on how we measure things in a paper. So to give you an example, so if a firm is headquartered in, say, in the state of Wyoming, if an investor from Wyoming accesses the EDGAR database, doing so, it will be tracked in the log file based on this person's IP address. So the fourth octet is being shielded, hidden by the SEC, but nevertheless, it will allow us, enable us to trace it back to this specific state. And so from all the traffic on EDGAR for this particular firm headquartered in Wyoming, we remove requests from, as we indicate here, web crawlers, index page requests with certain server codes, and also massive downloaders. So what's common in the literature is to exclude, if you're really interested in individual investor searching behavior, to exclude requests of, say, more than 50 filings, which the literature tends to denote as robotic search activity. And so we also are very specific about the type of information that these investors obtain, download from EDGAR. In this paper, we only look at earnings-related filings, which we denote as Forms 10K, Forms 10Q, so the annual report, the quarterly report, and earnings-related 8K filings, so the 202 filings, which are earnings-related. And so every time an investor downloads one of these documents, it's flagged as an earnings-related filing. All right. Now, so two parts. So the first prediction, theoretical motivation underpinning, if you like, for our first analysis, which builds on this literature, this growing literature on that their investors, when it comes to their information gathering abilities, they face certain limits. So meaning not all investors are created equally. For some, it's more costly and harder to gather information than others. And a particularly relevant paper from this stream of literature is the Goldstein and Young paper, 2015. They analyze a model where these different types of investors face different costs of acquiring information, marginal cost of acquiring information. And they explicitly indicate in their theory paper that this is something that could come as a result of some investors being proximate, others not, to a firm. And the nice idea, so the idea that they formalize in their paper is that local investors' initial information advantage, and this has been documented by a large series of papers, not only gives them this initial information advantage, but also a cost advantage in acquiring additional information. And I think that's kind of where our paper comes in. So loosely speaking, and loosely interpreted, this suggests that local investors, relative to their non-local counterparts, that local investors are expected to acquire information from these historical filings on EDGAR relatively more than non-local investors would do in an attempt to provide context for current information they have, or vice versa. And so, so here's the main finding of the paper. So what you're looking at here is total web traffic on EDGAR. Again, earnings-related filings being downloaded by local investors, so meaning from the same headquarter state as the company. And in here, we present it for minus 30 days in advance of the earnings announcement. So day 0 is the earnings announcement date, and until through 30 days after. And you see there's this increasing trend. So in local investors tend to intensify their search for earnings-related information in the run-up to the scheduled earnings announcement. And then it spikes on the earnings announcement date, and then it quickly levers off more or less back to normal. Now, if you do the same exercise for non-local investors, that's what we did here. Same graph. I mean, if anything, there's a slight decreasing trend. So closer to the earnings announcement, if anything, non-local investors tend to decrease their search activity, and there's a big spike on the earnings announcement date. And then it also rather quickly, within a few days after, levers off back to normal. All right, so this is the main finding, this asymmetric behavior when it comes to acquisition of, by construction, historical information. By construction, because at the time, so before the earnings announcement, the new filings are not available yet. So that means any activity here must have been downloading of information that is of historical nature. Right. So then the second part of the paper, we apply this measure to a premier, as surprising anomaly, as I said, which is the earnings announcement day premium. And so here, to say the theoretical underpinnings, we rely on a theory paper by Banerjee and Green, also in 2015 by coincidence, who study a nested model in which investors, aside from being uncertain about a stock's underlying fundamentals, so think about, say, a firm's earnings stream, investors are also, in this nested model, uncertain about what other investors know, whether they are more privately informed than they themselves are. And so one immediate implication from this theory model is that this being uncertain about others leads to an equilibrium price that is nonlinear in the information contained in a firm's earnings fundamentals. Meaning, based on this theory, we predict that the earnings announcement premium, so on the day of the earnings announcement, will be larger when pre-earnings announcement information acquisition by local investors is higher. And so in our empirical analysis, we will adapt the model from Stephan and Wilson and include time variant and time invariant firm characteristics. So the analysis that we conduct is really within firm over time. Now, so those are the main findings. So what we find indeed, that the earnings announcement day premium is indeed higher. So these stocks tend to elicit a higher stock price response when local investors are more actively acquiring information in the run-up to the earnings announcement. And so collectively, our paper contributes to a large and growing literature on costly information acquisition in financial markets. So in the paper here, both in terms of timing as well as in intensity, documents differences in information activity between the local and non-local investor groups. The paper also contributes to the seminal paper by Huberman back in 2001, Also looking into local versus non-local investment behavior. And in this Huberman's world, investors, local investors are subject to familiarity bias, and their model, their view on this world actually suggests that these familiarity bias-driven local investors are supposed to react passively to information events. Now, our findings suggest quite the opposite. Instead of waiting and sitting passively, waiting for the earnings announcement to come up and new information being released on the day zero, we find that local investors intensify, that is not passively but actively, in the 3 work weeks before the earnings release, kind of to do their homework. I mean, that's kind of our interpretation of their behavior. Our paper also contributes to other like early work, like Ivkovic and Weisbenner paper, which papers claim that investors are in doubt. Again, some kind of static argument, endowed with private information, meaning you know something and that's it, full stop. However, again, our results suggest paint a little bit different picture here, that local investors would actually supplement this information they're endowed with, this private information, and with unfiltered public information, meaning not through like alternative channels like informational intermediaries, analysts, or the other. No, really unfiltered information. They will directly access EDGAR to obtain this historical information. Which also suggests that some prior findings of these local stocks earning superior returns could in fact be driven by investors who are actively, rather than again passively sitting. No, they're actively preparing for the upcoming earnings release. And that puts some prior findings, for example, by Perinsky and Wang 2006, in a slightly different perspective. Kind of these findings in that paper would suggest that this is due to some passive local, and which is really systematic of nature, information advantage. We also contribute to a more recent literature which finds that various proxies for demand for information, and there are quite a few proxies out there, are associated with stock price risk premium. We directly contribute to this literature that looks at the time series and cross-sectional variation and factors behind the earnings announcement premium. And one takeaway perhaps from our study is we don't make a big claim about this in the paper. As you know, this is called an anomaly, and various papers have made various attempts to find like whether there's a risk explanation or a diversification type of argument for the existence of the earnings announcement premium. Are finding that asymmetric information story could be at least be in part behind the existence of the earnings announcement premium for the stocks that we study in a paper, suggests that it's maybe like a rational asymmetric information story rather than a full anomaly. Now, a couple of caveats. There are lots of things that we can't do in the paper, and we're very open about this. So we don't actually know. So we observe these investors obtaining this information, but we don't really know, because we don't observe it, whether they actually process this information, so really use it. We do have several analyses in the paper which suggest they do. For example, we look at retail order activity, meaning we're just checking whether they sit and wait, like sit idle on the information, or already like actively trading on it in advance of the earnings announcement, and we find some evidence that suggests they do. We also, based on a recent paper by Lauren Cohen and co-authors, this is a JF 2020 paper, where they look into like simultaneous downloading, year-on-year downloading of annual reports. And we find this behavior more strongly among local investors than for non-local investors, suggesting again, they're using information differently than non-local investors do. We also are acknowledged that plenty of alternative information sources, public information sources exist, are out there, other than EDGAR, which we look at in the paper. And we're perfectly fine with that. So as long as the use of these alternative sources would correlate also with the type of investor, like local and non-local, with our analysis, I think we can still reliably draw the inferences that we draw in the paper. So when it comes to the earnings announcement premium analysis, I mean, there's always this issue, right? Which comes first, information acquisition, or is this really driven by expected earnings news? Now, given the findings in prior literature that local investors in particular, local retail investors in particular, they do not have perfect foresight, we think this is a reasonable assumption that these are two independent forces in the paper. Now, I have spent like 20 minutes, so with 10 more minutes, let me quickly look at some and give you some findings. By the way, the paper is available online on SSRN, so full details can be obtained directly from the paper itself. Here are some of the data screens that we impose on the data. I talked about some in detail. I also want to highlight the volume of data. So we're talking about over 2 billion observations in our sample. So it's really, really demanding in terms of data processing. So here is the data selection process. I talked about the measurement. I talked about the earnings-related filings that we look at. I already showed you the graphs of local versus non-local investors. In the paper, I mean, so there's huge detail, so you can do all kinds of detailed analysis, including case studies. So the paper includes case studies like firm-specific studies, which is really insightful. In terms of validation, so we run a number of validation exercises just to double check whether our inference that our measure is really capturing this asymmetric behavior between local and non-local investors when it comes to their information acquisition activities. So we look at, for example, what triggers this type of behavior, this asymmetric behavior. So first of all, we correlate that with the earnings uncertainty. So this is based on option pricing data, and as you can see, this is the ratio of local to non-local traffic, web traffic on EDGAR, and that's the solid line, and the dashed line is the volatility, the option pricing volatility, which is our measure for uncertainty in earnings. And as you can see, there's a strong eyeball statistic which suggests there's a strong correlation between the two. We also look at when the latest IBIS analyst earnings forecast was available. So we obtain this data, and what happens is that exactly on the day before, so we do a break test, a Chow break test, and so with an unknown series and unknown break point. And so the data actually suggests that exactly 1 day before this break point, which is actually somewhere over here, on exactly 1 day before, this is where the last analyst forecast becomes available on average. So it seems like until that point, these investors were being guided by analyst forecasts, and as of that point onwards, they're all by themselves and on their own, and then they start actively obtaining this information. One other test I also want to emphasize and highlight here is we also looked at the small sample of firms which relocated their headquarters. So here's the graphical evidence. So essentially what we did is we looked into these firms and see whether there's a differential behavior in terms of like local investors acquiring information before the relocation and after the relocations, meaning investors which used to be non-local after the relocation become local. And that's exactly what these graphs, that's the picture that these graphs paint, that when before the relocation, local investors are the ones who are downloading and actively acquiring this information, and then gradually it levers off, as you would expect, because then the informational advantage, this home field information advantage, gradually disappears over time, and we see exactly the mirror image happening for previously non-local investors, and after the relocation becoming local investors, then this behavior starts to gradually kick in the exact same way as we document in the main analysis. So we also do various types of cross-sectional splits, but given the time, I'm going to quickly move on to these analyses here. So first of all, we check whether there's a difference between, let's say, earnings transparency in the filings. So the idea being that if earnings are more transparent, you don't have to be local per se in order to really grab the meaning and obtain the information content from these earnings related filings. And so that's exactly what we find. We find that this behavior, local investors tend to more actively and intensify their search for information more so if the earnings are less transparent relative to those filings which are more transparent, exactly consistent with intuition. Another analysis that we also do, which is based on a paper in finance, the Benila et al. Paper, from the 10K filings, they measure whether information is local or non-local. So in our case, we count the number of times that a firm's headquarters state is mentioned in the 10K. And then we divide it by the total number of states being mentioned. And so this is our measure of how local information is. And so consistent with intuition, we find that, so the solid line here indicates local information acquisition in case the 10K, local information degree is high, and the dashed line indicates this for low local information. So again, consistent with intuition, we find this asymmetric behavior to be stronger and more prevalent when information contained in the 10K is more local by nature. Already mentioned the simultaneous downloading, mentioned the finding that they actually put their money, these local investors, where their mouths are, based on the tech data from an analysis from Böhmer et al. Now, having only 3 more minutes to go, let me quickly talk about the findings for the earnings announcement premium.
It's more like 5 because I took it in the beginning. So.
Perfect. Then I'm going to slow down a little bit. So as I said, we adopt this model specification from a JF paper, Severin Wilson. So we measure essentially all variables in the exact same way as they do. The only thing that we change is 2 things. We replace, of course, our variable of interest. So we add that, which is local traffic, the natural log of local traffic measured over -15 to -1 days in advance of the earnings announcement. And we impose fixed and fiscal quarter fixed effects. So again, according and corresponding to the original Severin Wilson model, we develop an algorithm. So in our sample, we only include firms for which the actual earnings announcement date corresponds to the expected earnings announcement date. So we developed an algorithm which predicts what the expected earnings announcement date will be, and then only include those where both match. All right, now in the interest of time, so here are our main findings. So we can perfectly replicate the original Severin Wilson findings. Then we include firm fixed and time fixed effects. And so as you can see here from column 2 onwards, we find a very robust coefficient on our variable of interest, indicating that the earnings announcement premium, so stocks with higher local information search activity in the run up to the earnings announcement, exhibit a stronger price reaction on the earnings announcement date. We do all kinds of various splits, various sensitivity checks, using various return windows, also measurement windows. We consider for institutional ownership, and so on and so forth. And as you can see, our main findings remain robust. And here too, we conduct like a horse race of a battery of cross-sectional analysis. We exclude and only include non-money center states, also kind of to capture maybe differences in, say, information acquisition behavior stemming from non-individual investors, these investor institutions. We look at pre-public earnings information accessibility in the same way as we did in the first part of the paper. So if we split the sample into high and low earnings transparency, we split the coefficient, I should say, then we find stronger effects, again, with low earnings transparency. If we redo the analysis, the Benile et al. Analysis on localness of information in the 10K, we find stronger findings that the effect of local traffic on the earnings announcement premium day return is higher for when filings contain more local information. Again, consistent with intuition. So this is the final thing that I want to mention here. We look into the media coverage. I already alluded to this. We only looked at the earnings-related news items. In a sensitivity check, we also looked at all other news items covering a firm, and the results are robust to including this. Then we also conducted a placebo test. So instead of taking the actual headquarters, we then randomly localized firms to certain headquarters. In the same way, also investors to various headquarters. So we did it in two ways. So any randomization, so any except for the firm's actual headquarters state could be assigned. We also did a more like a tougher test where we only drew from neighboring states. So we call this the neighboring randomization, and the results are robust. We also repeat this any randomization procedure 100 times, and then re-estimate all the regressions and find that except for one instance, the placebo variable coefficient in other 99 other cases was statistically insignificant. So to recap, this study documents previously undocumented geography-related diversity in information acquisition with proximate, that is local investors intensifying their information search before the earnings announcement, obtaining historical information from SEC filings, whereas their non-proximate counterparts, they show a tendency to wait until new earnings filings information becomes available as of the earnings announcement date. Which is consistent with local investors having an initial information advantage, which also gives them an advantage in acquiring additional information from public information sources. And I think that's it for now. So I want to give the floor to Jordi. Thank you so much.
Thanks a lot, Stephan, for this very fluent presentation and all the impressive work you've done. So now let's hear Jordi's comments. So the floor is yours for 15 minutes.
Thank you. Very good. Can you see my slides? Yes,
you're good to go.
Very good. So thanks a lot for the invitation, Michael, to discuss the paper. It's been a pleasure reading this paper. Stephan has done a great job explaining it. They have put in a lot of work into this paper, and I think that we saw that from the presentation here today. Like that, there are like millions of tests there to show the results. So let me summarize, talk a little bit about the paper, and then I'll give some comments and suggestions about the paper. So very good. So what's the objective of this paper? And my take is that basically what this paper is about testing whether like local investors supplement their information advantage, their private news with public information. Okay. And the main contribution of the paper is to create this new measure of information acquisition that is able to distinguish basically like how locals acquire information and how non-locals versus non-locals, right? So basically try to distinguish this information acquisition behavior of locals and non-locals, okay? And the two main results that I see in this paper is like, first is like documenting this information acquisition behavior between locals and non-locals, and like they do this by running like many tests, and Stephan did a great job explaining them, and also basically by showing later on that basically higher local information downloads is associated with stronger price reactions on earnings announcements. Okay, so basically this behavior has effects on on the price reactions after some announcements. Okay, let me show you the. Stephan also showed this picture. I think that this is the main pictures of the paper that summarize well the paper. Is that we see in the left-hand side, we see how basically local traffic, how local investors behave, and we see that basically there is a change in the trend, basically from 30 days before to basically to the day of the announcement, and there is a steady increase in downloads of these filings. And you see that basically for non-locals, you don't see any change or even negative. I actually thought that there was no change, but Stephan just pointed that the trend was even a little bit negative. And then basically on the day of the announcement, there is a very sudden spike, right? So I think that's basically from a visual point of view, this is this documenting of the information acquisition behavior of locals versus non-locals. Okay, so now let me do my job as a discussant and provide some comments for the authors to think about this. Okay, so I think that my main comment would be about sharpening a little bit more the story behind these results that you're getting. So there is in all these stories, the paper has many stories, and sometimes it's okay, you go from this theory paper to this other theory paper and this other theory paper. All of them have basically a common ground, a common main assumption is that locals have some sort of information advantage. There is some sort of initial information asymmetries, and I think that we all buy this. We have already lots of evidence. Then what the authors show is that basically what this information advantage, then it leads to different information acquisition behavior about public information, and this is important. So so there are several stories that are in the paper and also in the presentation, and I think that it would be good just to focus on one of them, and because all the others, I don't know if you cannot be consistent with all of them. They might lead to contradictions with one another. So these are the four stories, and the one that I like the most, I think, is the first one. But and let me tell you a little bit why. So basically, here, the first story is that basically you supplement your private information, your local advantage, with public information. Okay, and this is, I think, that the key story in this paper is basically that we see that the behavior on information acquisition about public information is different between locals and non-locals. For this story to be true, there must be some sort of limited attention or some friction there that I haven't seen in the paper that maybe you the authors want to mention. And right, because normally in most finance papers, public information is it's a public signal and it's free for everyone, right? So here you need some sort of limited attention type story, type of friction that maybe you want to add to make this this story hold a little bit better. There's other stories that come up in the paper is that, there is initial information advantage lowers the local cost of acquiring more information. I think that in these papers, normally acquiring more information is more about, they talk more about acquiring private information. And so I think that since here we're talking about public information, there is a little bit of attention here. So you take this story a little, I will be more cautious about this. And the same about the third story here. So basically you have, we have uncertainty about fundamentals plus uncertainty about information levels of others. It's hard to document that you have uncertainty about information levels of others here. No, I think that the main the main premise here is that locals have an information advantage about local stocks that non-locals don't have, right? So I think that it's kind of common knowledge. So this thing about this uncertainty of information levels of others, at least it's not clear to me. So, and then there is the information acquisition diversity. I think that this refers more about that investors acquire, local investors and non-local investors choose to acquire different types of information. And I find this very interesting. I had not thought about this before. but there is just a small test in the paper about this. So you downplay it and just focus on one. I think that basically having a common story that goes through the whole paper, it's better for the reader. So that's just a suggestion that I would give the authors. Okay. Comparison with related literature. So basically the reason I was invited to discuss this paper is because I have a recently published paper with Peter Chiraki and Thomas Wu. Stephan was not aware of this paper, but let me just summarize very briefly. It has a very similar flavor, but so I think that it would be good for the authors to compare the findings. I think that the results are different, and so I'm not saying that this paper is destroying the results. I think that they are complementary, and they are going after very similar questions. So basically, the idea of this paper is that in models of attention allocation, whenever investors receive private news, okay, so if an investor receives private news, then these investors have a big incentive to go and acquire public information. Okay, now the observation of private news is hard, right? We don't know when people get private news, but what we're trying, and we have some data, is about how basically how people acquire information from public resources, right? So this is in our case, we focus on Google searches. In Stephan's case, you could think is these EDGAR downloads, right? So, and basically what we do in that paper is that whenever we see that locals start searching about a stock much more than non-locals, okay, whenever there is an abnormal increase in search behavior or a change in the behavior of searches of locals relative to non-locals, this means that something happened. Okay, this means that private information just arrives there, and then basically what we see in that paper is that that's associated with price increases. Okay, so basically we use this public acquisition, information acquisition from public sources to infer the arrival of private information. Okay, so that's so you can see that this has a flavor. I think that what we do is much more narrow than what Stephan has talked about. So in that sense, but a comparison, I think that should be added to the paper. An alternative story here maybe could be asymmetric information, right? So my question here is do investors receive private news every quarter? Do they have do we get information at every quarter? If it's yes, then then basically the patterns of information acquisition from EDGAR or from public sources are going to be very similar quarter after quarter. So basically there will be a one-to-one relationship between these initial information asymmetries and the information acquisition behavior. So therefore maybe what you're capturing is just information asymmetry. Instead, if you say, oh no, there are no private news at every quarter, then maybe you want to go and try to use the behavior or basically these downloads to basically try to figure out when private news arrive and when these private news are going to generate changes in stronger price reactions after earnings announcements. Okay, so just some thought. And yeah, I don't know how much time I have left, but I have a few more comments.
Yeah, take your time.
Okay, so I want a few comments about the measure. So the number of downloads of these filings, it seems quite small. So I think on average is for the locals, top of my mind, I think it was 60 for the 15 days, so 15 or 30 days before the announcement. So it seems like a small number of downloads. So can we really get conclusions here like broader, like given that we're like, you interpret these downloads as retail investors, so we're talking about like 16 retail investors in the previous 30 days making downloads. So I think that addressing this small number of downloads is going to be a key. It's going to be key for this paper. Another is like, why not normalize the measure, for example? So if you compare the state of California and the state of Montana, they have very different populations. One will have like many more downloads by locals than the other just by construction. So maybe you could, I don't know, normalize by the total downloads from state or something like this. And you kind of do this in your regression analysis, but they have like different timings. One is like from like day -15 to -1, and the other is from 0 to 2 or something like this. So it would be like, if they have the same timing, I think that the normalization would work. And also maybe when you're documenting all the behavior, like it would be interesting, I think, to have like this normalized measure somehow. I don't know. Another question that I have is like, so these are like questions that pop up while reading the paper. So I don't know. So why would you download these historical filings just before the announcement? What is the rationale for this? And which kind of investors are doing this? Don't they have the data already? Or are these then like not very sophisticated investors, maybe? I don't know. And then like I have like a couple more comments. So we're just focusing at the state level. I see that like, you talk a little bit about measurement error in the paper, but have you tried, I don't know, something or like on the Koval-Moskovitz paper, I think it's 2001 or 1999. Basically what they do is basically from the headquarters, they look at a radius of 100 kilometers or 200 kilometers from the radius. So like you could do this with zip codes and consider that local. That is something that I think it would be very cool because you have the IP address. This is something that, for example, in my paper, we could not do, and we have to rely on state level, like Google searches. We try to go, like in that paper, we tried to go into like municipality, but we did not have enough search volume there. But I think that maybe you can do something like this, like creating like the radius instead of just the state level. I don't know. Then also, when you document this is more about consistency a little bit. When you're making this documentation about like this new data and how like this behavior of local versus non-locals, you document a lot about the ratio of local traffic versus non-local traffic. But then when you're running the regressions, then you just focus on local traffic. So I think it would be nicer to have like things a bit more consistent, like from your documentation to the regression. And then just like a more of a minor thing, I think that it would be nice to, if you also explain a little bit how large are the economic effects of the coefficients. So like that's something I was not able to figure out well. So like basically it's like, are we talking about like how big is the effect? I was not, so yeah. So but overall, like I have really enjoyed reading the paper. Really, like it's very nice. There's so much information there. So I recommend everyone to have a look at the paper. Very good.
All right, thank you very much, Jordi, for the discussion. And Stephan, would you like to take a couple of minutes to respond to some of the comments?
Yeah, please. I mean, if there are no other questions from the audience, which I'm also happy to take, I'm happy to respond to Jordi's discussion. Yeah, on the theory and on the storytelling. So that's indeed something that we're working on. It's something that so this is more like a gradual type of argument that we were using here. First of all, So we need to understand this. So why these investors at all are obtaining this historical information, right? And so that's also something that you brought up in your discussion. And so we feel that one of the reasons why they might be doing that is they do indeed have obtained private information, and they want to give context to this information. And so, so maybe some piece of information that they have obtained, they learned from their, let's say, local sources, is about a certain activity. And so if they want to assess, say, the volume and the potential impact, you go online, go to EDGAR and obtain a historical filing. And so it put things in context, in perspective. And so this could be an argument. So this is kind of really gradually building our argumentation here. So that means that if a non-local investor, so now I'm talking about a second part where we look at the asset pricing consequences. It's no longer that the non-local investors are uncertain about fundamentals of earnings, but that means observing this behavior. I'm not saying that they observe this behavior, but knowing that local investors have both a home field initial advantage and also have a cost advantage in acquiring additional information. That means they're really uncertain, like what do these other investors know? And so we do feel that both factors play a role when setting prices around the earnings announcements. And so that's kind of, so it's really like gradually building arguments. So we start from this documentation, this finding that there's this asymmetric behavior. There we need a theory to explain this. And then given that they have obtained this information, and we're assuming indeed from that they have obtained and supplemented their private information with newly obtained information from via public sources. And this could be like just, backing what they already knew. It could be new information, but that could make the existing non-local investors more uncertain as to what do these other investors really know. And that's the argument that we need, and that ties into our asset pricing test. So it's really these two parts, and one goes with one theory, and knowing and having found these results, then we need to have this as a bridge in the asset pricing test. But I'm fully with you. We need to really streamline the storytelling there. So in terms of the number of downloads, yeah, I mean, this is a fact. The number of downloads is small. I mean, also Law Firm McDonald's have spoken and have documented this. The magnitude that we find is similar to what they find, so that's reassuring. However, it's important to know there's huge variation, both within firm as well as across firms in the cross-sectional sample. So we're talking about, so the numbers that you gave, like 67, which is the analog of our variable of interest, 67 total downloads, -15 to -1 by local investors. 67 total downloads on average again on the earnings announcement date through 2 days after is 84. These are indeed small numbers, but again, if you do case studies, if you look within firms and also over time, there's much more variation, and these numbers can go up easily like in the thousands for larger firms and the smaller. So we also have a table in the paper where we give full detail. What are these high local, low local, high total, low total type of firms? And you will find the usual suspects there. So there's considerable heterogeneity, and that's also something that we exploit. Talking about normalization, so we tried various things. So we tried to measure indeed abnormal traffic by benchmarking, say, traffic during the -15, -1 period to what happened before. I mean, that's also standard from what I know in the Google search literature, if I can denote it that way. So we tried that, didn't affect our results. In our main analysis, so in the second part, we include firm fixed effects. So that's kind of already like a normalizing force. In terms of the ratio and consistency, so most of our analysis, we present the local and the non-local separately. Only, I think, out of the top of my head, in 2 places in the paper where we present like collectively in a ratio, because I mean it's easier, to present. But all results go through whether we scale or non-scale. For example, in the earnings announcement premium analysis, in the second part of the paper, we have both local traffic, -15, -1. We have, in the same model, we have non-local traffic measured over the same window. We also have included, again, this speaks to the normalization, traffic that happens outside this run-up period. So out of the top of my head, -30 days till, let's say, -16. So immediately close to the run-up period that we look at, again, both for local and non-local. And so we also explain why, in the end, we did not include the ratio, instead looking at levels here, because we really find that these, in terms of the asset pricing effects, all comes from the local investors, not from the local non-local investors. Yeah, historical findings, I think that's kind of the ultimate question that's behind our analysis. That's what the paper really tries to speak to. We tend to look at this like a preparing, doing your homework type of document. So you know there's a date in the agenda in your schedule, the earnings are coming up. You have received some information, or you're in doubt with some private information. And in order to prepare for the upcoming earnings announcement, you collect some historical filings information from EDGAR to provide some context. That's essentially, I think, what's behind our analysis. And that could make these other investors more uncertain about what do these other investors really know at the time of the earnings announcement. So yeah, thank you so much for your feedback. And I do feel indeed that both papers, there's room for both papers. I mean, one of the interesting findings in your study, I think, is you use monthly data, if I'm not mistaken. And so you also look at asymmetric attention indeed between local and non-local investors. Interestingly, from our perspective, is that you don't find any asymmetric attention around earnings announcements. And I think that's kind of where we step in. And maybe one explanation is that you don't find it potentially, is that you really have to look into, say, closely to the earnings announcement. That's what we do. And really in earnings related information, something that of course is harder to do when it comes to Google search and Google attention. So we can really zoom in on the type of information that they're acquiring. And so we find this behavior for earnings related information. But thanks a lot. Yep. Is there any?
Perfect.
Yep.
So when I look into the chat, I can see one more of a suggestion than a comment that's perhaps you could use the sort of MSA locations instead of states. So that's third option on top of what Jordi suggested with the 100-kilometer radius.
Yeah.
Because indeed, I guess in the states you have some of these MSAs that actually span states or cross states boundaries.
Correct. And so I also forgot that, something you brought up indeed, Jordi. So yes, we have the data. So we could take it like a level to the next level, to zip code or even like street addresses. But that becomes way, way more noisy. So in the paper, we provide a descriptive statistic. This is based on analysis done by these IP location data providers. In our case, that's MaxMind. And they have documented, so they have actual locations of certain, like a subset of IP addresses, which they've been able to pin and to really like closely locate. And so they do these analyses on a regular basis. And what their analysis shows is that the accuracy of such like refined level of localization really goes, so the error is like, so accuracy is like close to 60%. So when you go, let's say, below the state level, at the state level, it's above 90%. And so that's the main reason at this point where we focused on state level. But we're happy indeed to extend. And maybe at this stage, we want to give that to the editors and referees to decide. So if they are pushing us to do so, we definitely can do that, but it will come at a cost that the signal to noise ratio will change most probably significantly. But there maybe we can also think about, doing some subsample analysis. This may be more like a case for a certain subset of firms than for others. So there are definitely stuff that we can do. Yeah.
Okay, so what I would do is close this official part of the webinar, and but that we can stay online and continue chatting. So I have actually a few things I wanted to ask Stephan as well. But let me first thank you for the presentation, and to Jordi for the discussion, and for contributing to the series. And let me just remind everyone that we have one more event this year. So in 2 weeks, Song Ma from Yale University will be here. So make sure you join us. And like I said, if you would like to jump in with questions or comments, we can stay a little bit informally, and otherwise wish everyone a nice evening or rest of their day, and happy Thanksgiving to those who are.
Yeah. Same here also.